On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope you're all well, hope you've all had a good week. Let's talk about financial markets last week, then let's turn our attention to what's coming up in the days ahead. It was a good week for most global share markets. The S&P 500 in the US was up 2.4%, emerging markets were up 2.3%, European shares up 2.5%, UK shares up, but much more modestly, up about 0.3%. The Japanese Topix Index rallied 2.6%, so it hit new highs, and the ASX 200 across the Tasman also hit new highs through the week, and it finished 1.7% higher. The NZX 50 added 0.9%, so not too bad, a little bit more modest than those other markets, and we're still down about 2% this year. And talking about record highs, which a lot of markets around the world have hit in recent times, we're still about 5% below our record high, which came all the way back in January 2021. Interest rates, a bit of movement there. The US 10-year Treasury yield finished the week slightly higher at 4.3%, while here in New Zealand, the 5-year swap rate fell back a little bit. It fell 11 basis points, finished at a 3-month low of 3.4%. Right, let's run through some of the key releases that we saw, and here in NZ, the highlight was the labour force report for the June 2025 quarter. Good news and bad news. The good news was that it didn't go up as much as expected, but the bad news was it still went up. So the unemployment rate increased from 5.1% to 5.2%. So that was below market forecasts. Markets were expecting an increase to 5.3%, but it was in line with what the Reserve Bank was expecting. So that's a better outcome than expected, but unemployment still at the highest level since 2020, when it also hit 5.2, and apart from a 3-month period back then, in the third quarter of 2020, it's at the highest level we've seen since 2016. The underutilisation rate, which gives a broader measure of untapped capacity in the labour market, it includes things like people that are working part-time but they really want to be working full-time, or people that are getting some hours so they're not technically unemployed but they want more hours. That increased from 12.3% to 12.8%. So that is also the highest we've seen since 2020. Wage growth softened. Private sector wage growth slowed to 2.2% per annum. That's the lowest since 2021. And public sector wages, which is where we've seen a lot of gains in recent years. You've had all those sort of wage agreements with teachers and nurses and other groups, all very deserving groups, I should add. Public sector wages grew at the slowest pace in more than 3 years. So from a Reserve Bank perspective, there's nothing in this report that will put them off reducing the OCR at their next meeting, which is next Wednesday the 20th. So I think we will see another cut. It will be 25 basis points, and that will take the OCR to 3%. And then there's probably one further cut to come after that. But I think you'll definitely get a cut next week, which will be a positive for investors, for borrowers, for markets. Dairy prices, we also had the results of the latest dairy auction last week, and pretty solid. The headline Global Dairy Trade Index rose for a second consecutive auction, which is good. It rose 0.7%, pretty solid results from whole milk powder, skim milk powder. They drove those back-to-back gains, and prices at the headline level are up about 4% this calendar year. Currency moves, still a bit of a headwind. The Kiwi dollar is up about 6%, 6.5%, I think, against the US dollar. So that is a bit of a headwind for local dairy prices. However, it's still very early in the season, and most economists are hopeful that we'll see another $10 payout from Fonterra, which would be the same as last season. They've got a forecast range of $8 to $11, and where we land within that range will ultimately depend on how global demand moves and how currencies play out, and so on and so on. But at the moment, Fonterra is pointing to $10, which is sort of in the top half of that range, and most economists are there or thereabouts too. On the central banking front, the highlight was the Bank of England, and this was really interesting, really interesting. The Bank of England did cut interest rates as expected, but it was a really close call. It reduced its policy rate by 0.25%, so that takes it down to 4%. That's down from the 15-year high of 5.25 that we saw through 2023 and 2024. However, it was not an easy decision. They've got a committee and they vote on what to do. And they were initially divided, 9 people on the committee, and it was 4-4-1, so a stalemate. And for the first time in the history of the Bank of England, and it's been around for a lot longer than the Reserve Bank in New Zealand, it had to hold a second vote to get a majority. And they eventually got one. But really interesting that it was tight, very much a line ball call. And the Deputy Governor and the Chief Economist both argued for keeping rates unchanged. So they didn't vote in favour of a cut. They wanted to leave things as is because they're worried about stubborn inflation, they're worried about high uncertainty. So that division within the Monetary Policy Committee saw the British pound strengthen because people are thinking, well, geez, if it was pretty hard to get that over the line, we might not see another one for a little while. So markets still see further cuts from the Bank of England, although possibly not until very late in the year or maybe into 2026. So that was a really interesting one for me. And we saw something similar with the Fed, didn't we, where we had 2 dissenters. And that was something from memory that we hadn't seen since 1993. So we are at an interesting time for central banks where it is not clear cut what they do next, and we're getting to that point where there's a bit of division within some of these groups in terms of what they believe is the right course of action. Okay, turning to the week ahead, and there's a lot going on. As always, globally, tariff headlines will remain a focal point this week. That pause between the US and China, the 3-month pause, that is due to expire on Tuesday. So we'll be watching for any headlines around that, whether we see an extension, whether we see any outcomes. It's been very quiet, hasn't it, on the US and China tariff front. Also, on the geopolitical front, US President Donald Trump has also announced that he plans to meet with Russian President Putin on Friday in Alaska. So that's on the 15th, and he will be looking to broker a ceasefire agreement and bring an end to the war in Ukraine. I'm not sure what his chances are like. I think Putin will very much want some territory in exchange for any ceasefire, so we'll see how Trump goes. We'll see how good his negotiating skills are. On the economic front, the US Consumer Price Index for July will be one of the highlights. This is out overnight on Tuesday, the CPI, and we've seen some modest evidence of tariff-induced higher prices in the US, so this is expected to continue in this report, and it could be the one that starts to show more signs of increasing pressures. So the headline CPI expected to rise 0.3%, the core CPI 0.2%, both of those would be unchanged from the previous month, but at an annual basis, this would see the headline push up to 2.8% and the core rate push up to 3.0%. So those would both be the highest that we've seen since February. Now, markets are still looking ahead to the next Federal Reserve meeting in September, and they see an almost 90% chance of a rate cut of 0.25%. Now, that's largely on the back of softer economic indicators. Remember, we had that terrible jobs report that we talked about a week ago. The ISM manufacturing index was much weaker than expected, and actually last week we saw the services ISM, and it was barely above break-even. I think it came in at 50.1, which is only just above that break-even level. That was weaker than expected too. So you've had a raft of softer economic indicators, and markets are quite confident that the Federal Reserve will have to resume that easing cycle in September and keep cutting from there. But it'll be really interesting to see if we see any reaction or any movement in those odds if you get an upwards surprise on the inflation front. So Tuesday night in the US, that will be in focus. While we're talking about central banks across the Tasman, we will have the RBA decision, the Reserve Bank of Australia, and they do look like they will cut interest rates. Remember 6 weeks ago, they surprised everybody by leaving interest rates unchanged. Everyone thought there'd be a cut and there wasn't. Well, I think you will get the cut this week because inflation has weakened. We've had some new figures out since then, and the headline CPI in Australia rose just 2.1% in the June quarter. That's the lowest in almost 18 months. And the trimmed mean CPI, which is actually the Reserve Bank of Australia's preferred way of measuring inflation, the trimmed mean CPI increased more, 2.7%, but that was still the lowest in 14 months. And it was down from 4.0% 12 months ago. So looks like a done deal that you'll get a rate cut across the Tasman on Tuesday afternoon. It comes out at 4:30 p.m. NZ time, and market sees 75 basis points of easing in total from the RBA over the next several months. So that would take the cash rate to close to 3% through the first half of next year, same as where our OCR will be by the end of next week, and I think markets will take that positively. Right, here in New Zealand, it is a little bit quieter as we build up to that Reserve Bank decision next Wednesday. There's a few things to watch though. We've got the ANZ trichometer, we've got electronic card spending, we've got migration, we've got selected price indices, which is a bit of an inflation indicator, and we might get a housing market report. We should get the Real Estate Institute report for July this week. Not sure what day. It always comes out at 9 a.m. on about the 10th business day of the new month, so it might be Thursday morning or a day either side. Be interesting to see what this looks like. Last month's release still pointed to a very sluggish market. Activity was higher, but the days to sell continued to push out and prices slipped on a national level at least for the 6th month out of the past 7. So a bit of good and bad there. I think that housing market recovery is still on the horizon, but we probably need an interest rate cut or two from here, and we need to see a few people roll off their mortgages onto those lower rates, and we need to see a bit more optimism and a bit of a turn in sentiment because things are still very sluggish out there. It's still very much a mixed bag across different regions and across different sectors. So we'll wait and see if the housing market is showing any signs of life. Also, on the corporate front, there is plenty to talk about. The international reporting season is actually starting to wind down now. We've seen about 90% of S&P 500 companies report results, so it's almost all behind us. A few stragglers still to release results this week and next week, but it's nearly done and dusted. Been pretty good in the US. 80% or more of S&P 500 companies have beaten earnings estimates, so that's good. And the aggregate growth rate for the index overall for the June quarter compared to the same quarter in 2024, the aggregate earnings growth rate has been 11.8%, which is awesome considering that before the reporting season started, people were picking 4.8. So much higher than expected. That hasn't been across the board. You've had a few of the heavyweights deliver some very good results, and that has pushed the numbers up. So still plenty of companies that aren't doing quite as well as that. But look, it's still been very good, and the third consecutive quarter of double-digit earnings growth for the S&P 500. So that's one reason why it's sitting pretty close to all-time highs, and it continues to prove resilient, even though you're getting some weak economic data and plenty of headlines about tariffs and all the rest of it. But as one reporting season ends, another begins. So here in New Zealand and across the Tasman and Australia, it will be a very busy month. We have a few companies reporting this week, and then it gets really busy next week. Most of ours will come next week and then the week after that. But this week we've got a few. PGG Wrightson, Vital Healthcare, Vista Groups are some of the smaller companies. Across the Tasman, it will be a very interesting one. We've got a few big results, and then it will get even busier next week and the week after. But this week, JB Hi-Fi, AGL, Commonwealth Bank. That one in particular is a really important one. Commonwealth Bank on Wednesday. That is the biggest company on the ASX, and I think CBA represents about 11 or 12% of the index, the ASX 200. So it is the biggest and most dominant company. I think BHP is still second, but CBA definitely the biggest. So where they go, the Aussie market goes. They're on Wednesday. Computershare, Amcor, Origin Energy, Cochlear, Mirvac Group as well. So lots to watch across the Tasman, and a few things here in New Zealand too. Internationally, like I said, we're starting to wind up. Still a few to watch though. Cisco, Tencent, Deere & Co. So a few bits and pieces. All right, team, that's it for this week. Thank you very much for listening, and we'll talk again soon.
For more insights, visit craigsip.com.